All right, welcome. Boroughs and Burbs, Season 4, Episode 138. We're doing the Wealth Report today. I'm going to share screen and begin with thanking our sponsor, Grace Farms. If you don't know what Grace Farms is all about, boom, that's the river building. And you can go to gracefarms.org, read about the foundation. Their mission is, well, it's an 80-acre campus, and it's a center for culture and collaboration. They bring people together across sectors to explore their 5 initiatives: nature, arts, justice, community, and faith at the Sana-designed river building and barns. That's it. I hope if you're interested in their mission that you come out to New Canaan and join them. Today, we're doing the Wealth Report, created each year by Knight Frank, the Intelligence Lab. This is their website where you can download the report or download the infographic. Liam Bailey is our guest today. He's an author of a great deal of the Wealth Report. You see Key Findings by Liam Bailey, and you've got The World Ahead by Liam Bailey. So we got the right guy today. That's Liam. That's the Wealth Report. It's great stuff. And with that, I'm going to stop sharing and say, welcome, Liam. I'm so glad to have you. Roberto asked last year, he says, do you know those guys? I love the Wealth Report. We should do a show on the Wealth Report. If you can get those guys on the show, I think that would have tremendous appeal to our clients in Manhattan. And so
here we are. I'm so excited to have Liam here because I've been reading his material for years. Him and his colleague, Kate Everett Allen. I'm a huge fan. So, Liam, welcome. Thank you for being here.
Delighted to be here. Thank you very much for the invitation.
So do you want to give us a summary of the Wealth Report? Or should we just hit the top findings, or do you want to start with any surprises this year?
Well, I thought it might just be, because I'm guessing some of your listeners and viewers might not be familiar with it. So I just thought I'd just give you like a 30-second kind of overview of why we do it. And we started the Wealth Report about 18 years ago, and so at Knight Frank, we thought there was a kind of gap in the market that there were lots of reports being produced by the banks and by financial institutions looking at kind of the financial wealth portfolio. And we felt that there was a gap, that no one was looking at real estate in the wealth portfolio, or certainly looking at comparing markets around the world, thinking about how money is moving and how buyers and investors are kind of moving to different locations. So that was the kind of genesis of the idea, and we wind on 18 years. And as you've just shown, the most recent edition, which came out just a little earlier this year, and we've expanded the report over time. But at the kind of the heart of the report is really measuring wealth, and there's some really simple questions. Where is money? Where's it moving to? And then what's the impact on real estate? That's our key questions, really. And in terms of this year's report, the kind of top line finding is that wealth creation is back. And you might be thinking, okay, well, why is that a story? But if we went back to last year's report a year ago, we were talking about wealth creation being in abeyance, that the rise in interest rates, that record rise in the cost of debt, had meant that actually fortunes had fallen around the world, portfolios had fallen. But we wind on a year, and actually we saw a reversal in all of that process. So I suppose, at the heart of the report is about wealth creation and understanding how that's performing. And in terms of this year's report, it's all about that return of wealth creation.
Any surprises this year? I think that I was surprised to hear that something like 24% of the ultra high net worth households out there planned to buy real estate in 2024. That was shocking to me. 1/4 of everybody, all the wealthy people, are going to go buy a piece of real estate. And how do I get in front of them?
Well, I think, look, for anyone in the real estate world, it's a great stat. I think the challenge is, what that's putting on paper is the fact that there is a huge appetite for people to consider opportunities in real estate. The question is always, you may well, you'll have wealthy clients who want to buy, they're keen to buy property this year, but can they find what they want? You know, and as we all know at the moment, most of the markets we're covering, the lack of inventory is kind of holding back transactions. So I think the willingness is there. Whether you guys or your colleagues are able to find the right property to tick all the boxes right now, that's the challenge, isn't it?
It is. So let me ask them. So that's 22% of people are looking to buy a piece of property. What is the other asset class? Is it that of the ultra, and like, can you actually define high net worth versus ultra high net worth is the way you see it?
Yeah, so, I mean, look, we take what what Wall Street and the banks have done to define wealth. It's been segmented over many years. So high net worth is generally meant to be kind of mass affluent. So people would say $1 million in investable assets on top of their house, their own property. So these are people who are kind of in the banking world. These are prospects for the future. These are people who are doing well, and they should be growing their wealth over time. And there are many millions of those people around the world. And then the ultra high net worth is somebody very fortunate to have $30 million or more in investable assets. So someone who's doing incredibly well. And there are approaching sort of 600,000 of those individuals globally. And those two segments we find really interesting in terms of the report findings, because where the super rich are going, where the ultra high net worths are going, you see trends set in the markets that they're targeting. So you mentioned about different asset classes. We talk about residential property. Obviously, it's the kind of heart of the report, and luxury real estate. But we're also thinking about, okay, well, what are the very wealthy doing in terms of, say, commercial real estate investments, and how are they viewing opportunities in, say, offices or logistics or other sectors? And we also touched on things like luxury collectibles. We found it a really interesting opportunity in the report to try and paint a very broad picture of the wealth portfolio. So we look at things like art and classic cars, fine wines, rare whiskies, and so on, to try and understand how is the overall portfolio performing, and actually what are those collections and those collectors of those passion assets. What does that mean to the real estate that they might want to occupy, they might want to invest in? So you think about some of the developments in Manhattan or in, say, central London, for example, where developers have thought through quite carefully about gallery space. If art is a big driver for wealth investment, then actually how can you showcase that to the best advantage in apartments? So as I'm sure you guys find, certain of your buyers are thinking not only of their own requirements, but actually showing off or showcasing their collections. So all of those assets we find interesting to track, and then to pull those results together in the report.
Is there, just thinking about art and these collectibles, is there a differentiation between, for example, cars and art from things like wine and whiskeys and things like that, which are really in some ways an expense because they will be consumed and gone, whereas there's a permanence to these other items?
But yeah, there is. You're right. I guess that a lot of people are investing in, say, rare whiskies and fine wine with no intention of drinking. I mean, a lot of this stuff is held in storage, and it's traded without really collectors actually touching the product. So I mean, there are collectors who will buy to share, and actually it becomes an important touch point for them to be able to buy incredibly rare and expensive wine, for example, and then share that with colleagues or friends or family, and that's part of their enjoyment. And I guess in some senses, it's kind of where the value is set in some of these sectors, is the fact that they are assets that are shrinking over time. Certain vintages are disappearing because they will get consumed, as you say, over time. The whiskey sector is an interesting one because it came not from nowhere, but I think the super prices that have been achieved more recently in the whiskey sector, they came upon the market quite rapidly the past decade. A lot of it was to do with Chinese and Indian investment. Suddenly the market expanded massively in terms of the depth of the collectors, the pool of collectors who want to buy rare whiskies, and that led to price growth, in really strong price growth. And we talk in this year's report about prices in the rare whiskey market coming back by 9%, but we touch on, and it's a big sort of part of the report really, is actually despite the fact that some of these luxury collectibles underperformed last year, and some of them saw price falls, classic cars fell in value. Outstanding examples, we report on a whiskey bottle that sold for $2.7 million, car over $50 million. Record prices were set for individual assets at auction last year, most of it in the US, to be fair. And actually, I was sort of drawing the illusion to this when I was presenting the report in New York earlier in the year. I wasn't trying to stretch the point, but these examples of incredible sales values at auction, they do point to the fact that even in a market that's tougher at the moment, and lots of these collectible sectors have had tougher markets, if you have absolutely the best in class asset and a really good example of a classic car or whiskey bottle or whatever the asset is, even in a difficult market, you can achieve outperformance and record pricing. And it's a little bit like real estate, that things have been a little sticky in the London market and maybe the New York market over the last couple of years. It hasn't been, a boom conditions. But actually, if you get the best, as if you get the best in-class product available and it's ticking all the boxes for your buyers, it will sell very well, and probably at the moment it's going to get a competitive bids. So there are some parallels I think are very interesting.
Can we talk about the demographics of who? Because now we're back. Tremendous amount of wealth has been created. But it seems to me, from everything that I see and I read, is that it's really accelerating in the younger generation, in the younger generations, plural, than it is really with like the baby boomers and the old, Generation X and things like that. Is that accurate or?
Yeah, I think it's fair. It's funny. There's two or three things we point to in this year's report, and I think it's a really interesting question because that shift in generational wealth we focus on this year's report, and there's a couple of things there, and it's been talked about by a number of commentators. Is this kind of the idea of the great wealth transfer? So baby boomers hold a huge amount of wealth, and over the next sort of decade, 2 decades, a lot of that wealth will be passed on to the next generation. And what we were looking at to an extent in this year's report was, okay, what does that mean? Because actually, if money and control of wealth shifts from, through inheritance, is shifting from the baby boomers to Gen Zs and millennials and so on, do they have different objectives as investors? Is there, just take an obvious point, is it true that young people are more interested, say, in, I don't know, sustainable outcomes, environmental outcomes from their investment portfolio than, say, older people? Is that a fair assumption to make? And the survey work we did suggests there's some truth to that. So potentially that has a read through to sort of the way that investors behave. But your broader point about younger wealth, I think, is a really interesting one. I had the same conversation today actually with a client that there is definitely more people in their 20s and maybe early 30s buying $10 million plus transactions in our big markets like London, New York, Miami, than there were a few years ago. But at the same time, that can shift quite quickly. Suddenly, if we see an influx of, say, Middle Eastern wealth into London, suddenly the numbers of buyers in their 40s and 50s will increase. It's not going in one direction. But I think the one thing that we've experienced, I know that you have, is there are so many more ways for people to make wealth really rapidly now than there were 10, 15 years ago because of tech and because of, say, crypto and so forth, that actually the numbers of very young people who've generated wealth incredibly quickly, that is a new phenomenon, I think. And that is having an impact in the way they spend and the way they invest and the way they view their entry into the property market. It happens so quickly. They want these things to happen immediately. And I think there are some new trends there, I think, because of that phenomenon.
What are those trends of how they spend? Like what I remember there was a time when the millennials didn't want to buy any property. They would sleep on their parents' couch, and all they wanted to do was travel, go have experiences. They barely had any money, and they would go, to the best restaurants in the world, and they would just like have the greatest experiences. But now, as they're aging,
they grew up.
Yeah, they grow exactly. They've grown up and they're like, hey, I want a house.
Is it because the average millennial has now hit 40 that they're thinking about family, they're thinking about schools, they're thinking about settling down, they're thinking about real estate in particular?
Yeah, I think that's right. It's funny, isn't it? Millennials, in your mind, you sort of think, millennials are young, but I mean, they're getting older. We're all getting older, but millennials are getting older. So actually, all those kind of boring, dutiful requirements of life become reality for everyone in time. I guess, I mean, just to your point about are there differences? So we asked a couple of questions in the report, which your viewers will be able to read, where we were talking about, okay, is there a difference between the generations in terms of their attitude to buying property and acquiring property? And there does seem to be a pretty much kind of linear trend that the younger the generation cohort, the less interest. As you get older, you become more interested. I think that trend seems logical and understandable just because of your life stage. But I think there's probably something in collecting less houses. The very wealthy are in a very fortunate position that they can have multiple homes, and that's lovely. So to have a second home is wonderful. To have a holiday home as well is fantastic. I think anecdotally, and I think the data does begin to point to this, that actually younger generations probably want a slightly simpler life, and actually the idea of managing a big complex portfolio of properties, which comes with quite a bit of hassle if you're not prepared for it, is not something which is as appealing maybe to the younger generation. So I think it may be a question of fewer better suited homes in time for younger generations of the wealthy.
They want big homes. Are they looking at townhouses in Paris and London and New York, pied-à-terres, or are they, after COVID and when everyone began to value green space and more space? So are the millennials, are the younger generation seeking one or the other or both?
I think it remains a bit of both. It depends on people's preferences, but I do think that, I mentioned that the New York market hasn't done a huge amount in terms of price growth. The London market hasn't done a massive amount in price growth, but I think those two cities there's different reasons why that's happened, and I don't think it should muddy the general tone that post-COVID people have embraced city living again. And I think that yes, there's lots of reasons why you might want to be away from from cities and enjoying green space and all those sort of things, but actually looking at the desire from the wealthy to be in Dubai or to be in Miami or wherever it is, there's still a continual demand from young people as well as older people to connect and to gravitate towards density and towards where other people are, where they can kind of build networks and connections and so on. I don't see that going away. I think probably it just means maybe you don't have that fourth home or a fifth home, but and maybe actually a second home is enough with maybe a holiday home as well. So it's slightly simpler living.
How about those, what did you call them, secondary markets or emerging markets? What are we calling those in the report? And why are they important, the emerging markets?
Yeah, I guess, well, I'm trying not to sort of contradict myself, but there's definitely, there's obviously been an increased degree of freedom from where people can be based, post-COVID, and that has supercharged trends that were already happening. So you've seen the ability of people to kind of untether themselves from the office and be based in different locations open up a whole range of opportunities for people. And we've seen that boom in the kind of footloose worker basing themselves in Lisbon or in different part of Porto in Portugal or in Spain or wherever. So I think the opportunities to base yourself in different locations and to experience a different country for a period of time has never been wider and never been more achievable. But I don't think it's a question of people choosing that as a long-term option at the expense of core cities and key cities. But I think it does mean that you are seeing a spread of locations where people would want to be for a period of time, and you you guys know the US markets much better than I do, but looking at the kind of the fastest growing markets in the US over the past 2 or 3 years, in terms of from a European perspective, cities that one never knew of in Texas or in the southern states that are doing incredibly well on the back of just rapid growth in business and technology sector businesses, etc., as unlocking new locations all the time. So I think actually for the kind of the more established markets, the more established wealth hubs, I think there is more competition, and they kind of I think the traditional markets where wealth has congregated, say Geneva or Paris or or London or wherever, there's more. You need to keep refreshing your offer to attract wealth and to attract the wealthy. You can't assume that you'll always be the most attractive place to be based.
So this is the PIRI 100. What is the PIRI 100, and why does it matter?
Yeah,
international.
So basically, one of the so if I talked about the building blocks of the report being understanding where wealth is being created and where it's moving to, the other one is then thinking about how it's impacting on real estate. And one of the basic metrics that we have is our Prime International Residential Index, the PIRI 100, and we track 100 markets around the world. These are luxury locations: Miami, Aspen, LA, Saint-Tropez, you name it. Anywhere that very wealthy people would like to be based, hopefully we've got it covered in the index. And the reason why it's such a good and interesting benchmark is, of course, prices in these different markets will be cyclical and they will be volatile over time. But you do see some trends coming out that point to a shift in where the wealthy are kind of favoring over time. And
I'm shocked to see Manila heading the list with 26.3%, way ahead of Dubai, Bahamas, way ahead of New York.
St. Bart's there?
Yeah. St. Bart's made the top 10.
Yeah. But
So
Manila's a really interesting one. It's you've got a market there which is, let's be honest about it, this is a domestic market in the Philippines, and actually there is a little bit of inward investment from other parts of Asia. But there you've got a market which is driven by economic fundamentals. The Philippines is, it's an emerging economy. It has some significant challenges in terms of kind of poverty and so forth as a country, but its economy is performing very strongly. Growth is happening, and actually the business sector and the business entrepreneurs and the business elites, etc., within the country are doing quite well at the moment. And therefore, actually, you're seeing quite a few of wealthy Filipinos have moved back into Manila over the past 2 or 3 years because the economy has been performing so strongly. So, that's the case in point. It's a trend that, or there's a data point that points to something happening in that underlying economy that's driving wealth, wealth creation, but also bringing wealth back into the country and actually allowing people wanting to be part of that economic upturn. And that's why Manila heads the table.
What's interesting about Manila in particular, but when I was a millennial, when I was in my late 30s, early 40s, I had a tech business. I looked around for where I could get an educated English-speaking workforce, and I built it in Manila. Manila's primary industry is call centers, and all of the Fortune 100 in the U.S. are looking beyond India and other into the Manila market. Manila is the #1 call center, and I relied on English-speaking tech educated workers in Manila to support my US-based business. So it makes perfect sense to me how a market like Manila could be comfortable to New Yorkers or LA or London as a secondary location to grow your business. Also inexpensive, highly educated labor. So yeah, it was a home run for me. So I get it. And that's why I spent an hour poring over this list and trying to understand why Manila, why Dubai, why the Bahamas, why the Bahamas.
Well, I think it's down to that point I raised about you can be based in different locations, and I guess also you've got the desire from there's an element of tax play, there's an element of lifestyle, and there's an element of the ability to base yourself in a location other than a big city at the moment, but actually to retain your big city links. But I think if you mentioned Dubai in the table, which maybe surprised that it wasn't the top of the table in terms of this year's results. Dubai has been the leading market on our index for the last, I think it was the previous 2 years at least, if not slightly further. And you've had that market has utterly repriced over the course of the past 3 years. So prices in the prime luxury Dubai market have increased by about 160% in 4 years. And still, to be fair, from a relatively low base, but it points to I guess a phenomena which has happened there, and it's reflected also in Florida, where you've had markets that have utterly transformed post-COVID because of some of those trends that really kind of were supercharged by the pandemic. So the ability of business to move and actually for workers to kind of pull business to some of these locations has really led the charge there and has driven prices. I mean, okay, price growth in Dubai has come off a little bit, in the last couple of quarters, but it's a market that has been totally transformed in the same way that the Florida market's been transformed, and again is why they're towards the top of the list.
So what struck me, though, is Manila and Dubai are too hard for me to get to on a direct flight from any of the major centers of capital. But the Bahamas is a quick flight. Miami is a quick direct flight. Palm Beach is benefiting right now because it's a quick and direct flight. So you have two different kinds of behaviors. You have companies that have, they're working remotely to places like Manila and Dubai, and other places on this list that are benefiting because they are proximate to London. And it occurs to me that the Marbella in Spain is proximate to London, and St. Bart's is proximate for New Yorkers. Is there some truth to that?
Yeah, 100%. So in the Caribbean market, which used to be much more influenced by UK buyers, has become, the American buyer and the Canadian buyer has become, they are the pivotal buyers in most of these markets. And as we note in the report, as wealth creation and economic performance in America has been so strong over the past 12, 18 months, that actually that's driven, the wealth wants to be invested and those markets have benefited. But to your point about proximity, of course, Dubai is very proximate, is very convenient for Indian wealth. I mean, it's a short flight from Mumbai to Dubai, and the joke really is that actually Dubai is India's best city in terms of the wealthy of India who may have thought of London as their first choice. They're kind of weighing Dubai against London at the moment in terms of an option for them if they want to buy a second home abroad.
I'm so glad you brought up India. I wanted to talk about the BRICS, the Brazil, Russia, China, India, and India specifically, because it's interesting that you bring that up, because we're here in New York, we're waiting for a big wave of Indian investment. And it just really doesn't come. Everybody says they go to London. So it's interesting that you're saying they go to Dubai. Is the Indian market still producing accelerating wealth?
Oh, 100%. I mean, I would say in volume terms, in terms of the wealth story globally, America dominates. I mean, it's obvious. It's the number one story in terms of what happens in America is having an amazing impact globally. We can touch on this. I would say the second story probably is India at the moment. I mean, China's important, but in terms of the Indian story, the economy in India probably grew by around 7.5% last year in GDP. It's the growth of wealth in India, at the kind of mass affluent level is astounding, and at the the ultra high net worth level is incredibly strong, and this is based on service sector industry growth and also manufacturing and other kind of reasons. So that Indian story is massive, and I think if you look at the Dubai market, the biggest buyers right now in Dubai it's basically Chinese, Indian, and actually British. In terms of the London market, so looking, the Indians haven't disappeared; they're still very strong, a big important part of the market. But they're probably number 4 or 5 at the moment in terms of the biggest buyers. The Chinese dominate, but Indians are still important. And I think you're just beginning to see Indian money showing up in some of the other European sort of hotspots. So you're seeing some big Indian buyers in places like Ibiza and the south of Spain and so forth. So it is beginning to impact in other markets, and it will only continue to do so as that economy just continues to grow.
Wow.
Impact of interest rates. That's all we talk about in the U.S. is interest rates and the Fed and whether the lock-in effect and whether so. What has been the impact of interest rates? When I look at the key takeaways in the report, it says lower interest rates are anticipated to shape real estate investment strategies. Can we talk about that on a global basis?
I mean, I agonize. Here's a problem with the report. Okay, I'll share a secret, but the challenge with this report, if I'm honest, is you're writing I think it's 80-page report, so it takes a bit of time to put together. It takes a bit of time to print and to distribute, and you're writing about themes which are kind of tied to the news agenda, and obviously where interest rates go is the critical part of the story. So when I finished writing the report at the beginning of February, knowing that the report comes out in early March.
And you were going to get 8 interest rate cuts back in February,
yeah,
right?
But I nuanced it. I nuanced it because I could see that it was shifting, and I think I allowed myself to say, look, it is clear that the next move is down. I mean, maybe 2 weeks ago it looked like it might go up, but I think that was a safe, assumption. The question was always going to be when and how much. I mean, that was, and how many cuts. So that was. I think we were fine with that, but. I think the problem at the moment, one of the biggest issues I think at the moment, and I think it's particularly acute in the US, is the biggest problem from higher interest rates has been how it's weighed on inventory. So anyone, as you know, anyone is on a long-term fixed rate, they're not selling because they want to keep that low rate. And I think the biggest impact of the rate cuts when they come is actually the willingness of vendors to think, do you know what, okay, I do need to move, and actually as rates are beginning to come down, I can do this now. And I think you'll see more stock comes into the market, liquidity begins to improve. I don't think it's a quick process, but it will be a good process. And so I think the biggest impact actually of lower rates is more on liquidity and stock volumes improving rather than pricing. I don't think it's a price story actually.
That's the problem here in the US, because here we have 30-year mortgages. So people who are locked at a low rate are locked for a long time.
95% of us have fixed 30-year rates.
So imagine that, like when we talk to Canada, we talk to Australia, all these places, their mortgages are 5 years. It's much shorter. So it forces that liquidity, it forces that turnover.
Yeah. No, I get that. I understand that. I guess what I'm saying is, I think the US is probably, you're probably going to struggle with tighter liquidity for a period. But I guess if rates come down from, if mortgage rates can come down, by 1% or 1.5% over time, I think it'll tip some vendors to think actually the push factors in their life are telling them they've got to move on. They've got to, upscale or downscale or whatever. And I think that at the moment there's such a resistance from moving because rates are so high. But actually, as they move down, you begin to see some people relent and actually begin to, risk moving off that 30-year low rate they've got onto a newer rate. But I agree, it's not a rapid process.
So how has your thinking changed now that we're all talking about higher for longer? Higher for longer. I just want to get that sort of buttoned down. Higher for longer, meaning we're getting comfortable with the fact that 6-7% is what we're going to get in America and we're trying to figure out, okay, if that's what it's going to be for the long term, where can I find opportunity?
Well, I think yes, that's a fair. I think in terms of the wider, in terms of the mainstream market, I think you have got a continued lower than, obviously lower than normal turnover, and actually you have a floor under pricing because of lack of stock and lack of choice, and the lack of ability of people to actually choose in the market where there isn't a huge amount of choice out there, and therefore your bidding price is higher, unfortunately. So I think that prices are probably held higher than they would otherwise be. I think the biggest change, I guess, in the luxury market, you have a different story, because there is, and we document it, significant wealth creation globally and within the US, and that money wants to be spent and it wants to be invested. And you talk about that 22% of wealthy people want to buy a house this year. There is a desire, there's an impetus for those people who maybe want to buy an additional home, or they want to trade, and actually they're not as impacted by the interest rate story. In the central London market, to give you an example, if you're above £2 million, so $2.5 million, let's say, about 55-60% of the market is cash at the moment. So you're not mortgaged. People may mortgage at some point because they can do something else with the money, but a huge amount of a large portion of the luxury sector in many parts of the world is cash led, which just means it has a little more flexibility even when rates are held higher for longer. Your point about investment, and actually how does that higher for longer environment impact on investment? Then we've got to be honest. I think about, say, the commercial investment market. In the commercial real estate market, it's been a really tough year. I mean, the past 12 months was very hard. 2023 saw pretty much a halving of global capital market investment in commercial real estate. So high rates have had a massive impact, and they're continuing to weigh on the market. But ultimately, things reprice. I mean, there has been a degree of repricing in the commercial real estate sector. There's always a clearing price, and there's always.
I want to hop on that. If I'm lucky and I pick in the top 10, St. Bart's 8% growth, but if I weigh that against in a high interest rate environment, I may go into bonds. I could go. I mean, with other investments beside real estate providing 8 and 10% returns. Is money going to come out of I mean, I know that ultra high net worth individuals, 25% of them are going to buy real estate, but it occurs to me that they're buying real estate for themselves, that for investment purposes, they're still not looking at those bargain buildings in Manhattan, San Francisco as a return on investment strategy, or are they?
I think people are, but I guess the problem is the jobs become a lot harder, because you're absolutely right. The alternative, you can make your money, your money can work much more easily in other sectors and deliver some very healthy returns. So the real estate has got to work a lot harder to meet those returns. So we point to the fact that if you're thinking about investing in real estate and trying to make the figures stack up, you've got to think much harder about the potential for you must believe the location, the neighborhood you're buying in is going to outperform, and there's something happening there. Is it infrastructure? Is it transport? Is it connectivity? Something's changing to change the performance of that location. That's the first thing. Is the building you're buying, has it got capacity for added value? Could you restructure the leases? Can the tenant mix be improved? Can the building be improved? Are there ways that you could enhance floor space? basement conversions, or attic kind of conversions, or extensions. How can you make that building and your investment outperform the market average, because maybe the market average isn't exciting enough? So that, I think, the level of work and focus from serious property investors at the moment is, it's probably never been higher. But I would say on that one of the questions we ask every year in the Wealth Report is, okay, what sectors would you like to, if you want to invest in commercial property, what sectors are you attracted to? And every year we get, to be fair, it tends to be the kind of zeitgeist sectors of where people want to be. So it's like data centers, it's kind of it's laboratory space, it's kind of it's all of these kind of new areas of investment. But actually, the biggest sector that you tend to find people focused on is offices. And the reason why is because they're quite liquid markets. There's lots of office space around. They're easier sectors to get into and actually invest in. And you think, well, okay, well, people aren't working in offices in the same way as they used to do. So why would you invest in offices? But there's an opportunity play at the moment. I mean, let me talk about London, because it's a market I know well. Knight Frank, we're aware of, I think it's over 80 requirements right now for office space in central London of over, I think it's over 60,000 square feet of accommodation. People want these spaces for new headquarter buildings. Of those requirements, 80% are for more space, not less space. And that's because the way that people are working their office spaces ever more intensely. They want that office space to be an advert for their business, for their brand. And you're using it for kind of talent attraction, talent retention. So if you want, I mean, just as an aside, if you want right now to get best in class space in central London, and it's the same is true in Manhattan, for your office headquarters, for your corporate headquarters, and you want 100,000, 200,000 square foot, forget it. It's not happening for the next 2 or 3 years. It's not available, because the space that the corporates want is super duper green space. It's got, BREEAM excellent, all the tick in the boxes. It's got amazing kind of circulation space and networking space and all of those things, and studios and whatever. It's not available in the right quantities. So actually, there is a massive opportunity right now to provide the right type of office space. But you're right that it's a bigger challenge than it's ever been to make the numbers stack up, because of the cost of debt, and actually because of the alternative investment opportunities.
So Liam, you're talking a lot about completely, and I completely agree, that the Class A space, really. But you talk in the report about, and here the Class B, Class C suffering with, and you talk about that there is the need for private equity to come in and repurpose and upgrade all of these, old commercial buildings. Is, with so much risk and so much uncertainty with regards to zoning and all these different things, I'm sure in every city.
And the return's so good in other sectors with high interest rates, I can just park my money and make the same return.
Is there a decent, is there a measurable risk? Is there a decent incentive? And is it appealing to dive into that? And are there any cities in the world that you're aware of that are actually succeeding at this better than others?
I think yes, it is an opportunity that you can make work, and we've got lots of clients doing it. I guess the problem is it isn't going to be at the speed that city authorities want it to happen. That's the problem. There are a lot. I can think right now, and sorry to give you another example from London, but I can think right now of an area like, say, Clerkenwell, which is an area just to the north of the city of London. It's kind of, it used to be an area of light industrial kind of space. It's a bit like Soho in New York. Beautiful buildings. Some of them are a little bit tired, but I've seen some unbelievable recent conversions and improvements with great retail space downstairs, fantastic kind of office space, and great kind of gym space and so on. And they're doing really well. And the developers who got involved in those, they've made money and they've made it work. The problem is, you need skills to do that. You need real attention to detail and skill sets to actually make that work. And therefore, it can be done, and it is being done. And the point I made in the report is, I think, is a fair one, that we need more capital to kind of help do that. The problem is, and it's a very fair point, but the problem is for your investor, the investor you just talked about, to pull together that team, the architectural team and the design team and the build team and so on, that's really tough. Those skill sets are quite rare. So it can be done if you've got the connections and you've got the network and so on. You can make money out of real estate even in this market. But the problem for, say, the city authorities in New York or in other cities around the world where this need for kind of transformation of secondary buildings is needed, it's just going to be much slower than they want it to be. And then I suppose you've got to look at things like regulation and planning to try and sort of ease that process. What can they do in terms of zoning or change of regulations to improve that process?
I want to pick up on the regulation point you made because I'm dying to talk about that. As I'm watching across the PIRI 100 and I'm watching all the emerging markets, and I know that the focus here is on places like Miami and Nashville and Texas. And, and the question is, when is New York coming back? When is London coming back? When I read in the latest report about the green regulations and the requirement in London by 2030 to make sure that the building conversions are absolutely green. When I read the headlines in New York, there's an overwhelming sense of trying to get affordable housing. Our developers and investors, I know you've been talking about how there's some success at the margins, but are we going to have to see New York and London and the established markets deregulate in order to compete with the emerging markets? Do you see that happening?
I think in terms of it's a really big challenge. I mean, I in the London market, for example, the numbers of housing starts.
And if you had a perfect crystal ball, they'd make you mayor of London. I know, but.
but my point is, I think there's a real challenge because you look at the rental market. We talk about the Period 100 where we talk about sales prices and of luxury apartments and so on. But actually, as you will know that rental prices in Manhattan or in London or in Singapore or in Hong Kong have way outpaced capital values over the past 4 or 5 years. And actually that points to a huge issue, which is around, as you say, affordability. So the experience of a tenant, someone's moving to New York for their first job and your experience as a tenant is awful. The accommodation is incredibly expensive. The competition to get into these rental properties is absolutely massive. So what do you need to solve that? And I think most policymakers have decided that actually rent caps are a terrible idea, which they are. So you think, well, you've got to encourage large-scale development, and there is, I mean, we are kind of following America slowly with the kind of multifamily sector, which is emerging, at a pace now in the UK, but from a very low base. And we're seeing the same process in other cities around the world. But that encouragement from government and from policymakers to zone locations and actually release land to actually develop more multifamily housing, graduate housing, and so forth, to actually allow renters to actually have a reasonable stab at actually living somewhere convenient for their job that they want to take in these key cities. But actually, just on the point you made about challenger cities, this is something which I think is really interesting, that in the wealth report, we talk about the mobility of wealth and the fact that, and this isn't a surprise, but wealth is incredibly mobile. It's become more mobile than ever, and people can be where they want, and the wealthy can choose. And it's meant that in reality, the wealthy tend to choose, and the affluent tend to choose the same places with some new additions. So it tends to still be London and Milan and Miami and so on. And then you get the addition of somewhere, let's say, like in Lisbon, in Portugal, which has been a big story for the past 2 or 3 years. There's been a big boom market. They had a golden visa program which encouraged you to buy property and live there and so on. They changed that recently, but it's still very popular. The problem for all of these locations where you've had an encouragement to attract the wealthy through visa programs or through flat taxes and all these kind of things is eventually you get pushback, because you have the wealthy will flock there and they'll enjoy the lifestyle. It's fantastic, and they'll really enjoy it. And then you get the external costs, which are passed on to the locals because accommodation becomes expensive. Competition for nice housing becomes very difficult. So,
and I'm thinking in the report when you say that certain incentives offered in Milan and Paris in order to attract the super wealthy and become financial hubs. You're saying there's going to be a backlash in Paris and Milan against that kind of behavior.
It certainly, yeah. Well, it's funny. It certainly happened in Portugal. I mean, they changed the rules quite radically recently because they were beginning to be. It was a problem in terms of the local population were feeling the pinch in terms of affordability. I think Italy may be a little safer because actually, it's a countrywide program. The flat tax structure they brought in, it's been very popular. But you're talking thousands of people, not tens of thousands of people, who've been taking advantage of it. So I think it's less of a problem at the moment, but I think there's always a risk that, at the moment, it sort of comes with the territory. If you are a successful city economy, wherever you are in the world, affordability is a problem. I was talking to a journalist yesterday about the experience in Sydney, in Australia. And in Australia, I mean, the story there is prices were dipping about a year ago. Prices were coming off because of interest rates. And they've picked up really strongly in the past 12 months, primarily because they've got a very strong growing population. They have a very strong immigration program. It was on hold during COVID. It then came back and reopened. Lots of people, lots of workers are moving into Sydney and Melbourne. And again, affordability becomes a problem. And suddenly it becomes a politically kind of charged issue. So I think the desire, coming back to your point from earlier, do people want to be in cities? Do the young wealthy and so on, do they want to be in cities? And they do. And actually it means that pressure on pricing on accommodation is just ever present. If you're a successful city economy, this will be a problem. And it's a real challenge for government to work with the private sector on solutions to this. But I think coming back to some of the points from the wealth report, this is kind of what we pointed to really was that there's a lot of private wealth being created. It has an interest in property, and it's needed more than ever in terms of helping to provide those solutions. But that doesn't get away from the very real point you mentioned, which is in this environment with higher interest rates, that is not going to be a quick process. But I think it's an exciting challenge, if you like.
So the secondary home, obviously with COVID, the people that were living in the urban centers, they left the city, but they didn't sell their homes. They just added another home if they didn't have it. And now if you have certain level of wealth, it almost seems like almost a requirement that if you're going to live in an urban place, you need a place to go also. If something like that were to happen again, just to escape the city, et cetera, et cetera. And then now there's even almost another incarnation of that. We did a show on Montana and ranches and things like that. Have you seen a market for just land? Or like here, people see, there's the concept of my own private Idaho, and where people are just buying land. In the case of this crazy world that we live in, it's Armageddon, and they have 25 acres, somewhere that they can go, and they can even, they haven't built anything yet, but that they can just, it goes back to the old, not that land, land is the original, right? It's the original asset class, land. But when you're in an urban environment, you think about apartments, it's a different mindset, and it's a nuance to it, but are people just buying land?
Yeah, I don't see Montana on your list.
I know. Give me another year, you'll be on there. But you're absolutely right. I mean, the farmland or rural land is an incredible hot property, and we talk about it in the report in terms of the growing numbers of reasons for people buying land, and some of it is around actually people do want to farm and so forth, but other people, they're looking at kind of environmental potential of land. But your point about security or kind of future-proofing lifestyles, I think is absolutely real. The problem, to be fair, in Europe is just the density of the population, particularly in the UK, for example. It's just land is so scarce, and the amount of farmland that's available to buy declines every year. There's a lot of wealth is invested in farmland, and it just doesn't sell. It holds it for the long term. It never comes back to the market. So that liquidity in the land sector in the UK is kind of gone. It's very hard to build a portfolio of land. But at a global level, there is, I think it is a continued growth story. And I think the amount of money looking at land, and I think some of it is wealthy investors thinking about that future-proofing story you mentioned. But I think also the amount of corporate interest in land outside of the corporate's normal area of work, but the ability to use land to plant trees, to offset carbon, to do all sorts of environmental improvements and stuff is absolutely massive. And again, that demand, from different sources is then facing a supply which doesn't really change in terms of the amount of land available to buy. So it's having a big impact in terms of pricing.
We've done 2 shows recently where this has come up. It's really interesting to me. We just came back from San Antonio and we said, can prices continue to rise? And they're like, oh, yeah. And they said, do you know how much land we have down here in Texas? You can be 15 minutes from the airport, and we have massive amounts of potential here down in Texas. We also had the same question on our Palm Beach show. And aside from the island, the ultra high net worth individuals who are buying fancy estates on Palm Beach Island, we had the head of development for Palm Beach County, and she said that they brought in, they grew by 200,000 last year and the year before that, and they're going to grow by 200,000 every year. And we said, is it sustainable? And she showed us a slide. There was a slide of sugarcane fields to infinity. And she said, yes, we can expand. We have the space down here in Florida. We have the right regulatory environment, and we are organized, and we are growing. And you know what? Sky's the limit. So go ahead, try and compete with that, New York. We're Wall Street South. And so in our last few minutes, that's a good segue to say, so where is the big opportunity? Palm Beach says that's, place with land, a quick flight from metropolitan centers, a great airport, and access to the wealthy, access to capital. We have the perfect mix. Where else do you see a perfect mix so that if I'm going to get my pen and take some notes here. Where's the opportunity for John and Roberto to make some serious money looking forward for the next 5 years?
Well, why don't we think about, why don't we go back to basics? Why don't we think about London and New York? I mean, you touched on it. The 2 cities which have underperformed in the index, they're not doing anything exciting at the moment. And I look at, say, the London market right now, and the residential market hasn't performed strongly in terms of price growth for about 15 years, if I'm honest. And primarily some of that was around taxation changes. We had a lot of stamp duty increases back in sort of 2014, 2016. And ever since then, prices have been a little bit flat. But actually, in terms of your dollar pricing in London, you're buying today in central London. If you're a dollar buy from the US, you are buying basically 45% below the value you were paying back in 2014.
And the rents are out of sight in London and New York. So the rents support that purchase.
Yeah. But if you're just thinking through, okay, let me make a case for London. So we just had the one of the only Brexit dividends we've had in recent years from leaving the European Union is the fact we don't need to apply some of the EU legislation, and the banker bonus cap that the EU put in place after the global financial crisis has been lifted in the UK, nowhere else in Europe but in the UK. So suddenly the banks can pay what they want in terms of bonuses. I spoke to 2 bankers yesterday from 2 different banks. I won't mention their names, but they talked about actually numbers of bankers based in New York who've been putting off coming to London because their bonus would have been capped. Suddenly London's on the agenda. But actually, meanwhile, while the housing market in central London hasn't been performing very strongly, the amount of investment in the luxury sector in London over the past 5, 6, 7 years has been extraordinary. There's been a record number of unbelievable. Hotel openings, restaurant openings, you name it. There's been some great branded residence schemes. The brands who've moved into London in the past 4 or 5 years are incredible. So actually, central London looks really well, and the pricing you're paying for a Chelsea townhouse, £1,500 square foot. So I don't know what that is. That's $1,800 a square foot. It's the same you were paying 10 years ago. It hasn't moved. So actually, the opportunity, I think, is there in terms of the London market. Don't know if is that exciting enough for you though.
$1.8 million for 1,000 square foot apartment in Chelsea.
Yeah, there you go.
I could
It's
do
a
that.
buy.
I like it. This has been a really great show.
This is amazing.
So
Liam,
much.
thank you so much for coming on. I've been following you for years, so to have you on is a real pleasure.
Well, thank you very much for the invite.
We are two of your biggest fans. I want to thank our sponsor, Grace Farms. Go visit them at gracefarms.org. Go see Grace Farms Food website for more information on the Design for Freedom initiative. And then go to knightfrank.com and download the Wealth Report, where you can see all the charts and all the insight from Liam Bailey and his team in London. Thank you so much, Liam. It's been a great show. We're going to have you back and find out whether any of your predictions were right. And New York and London will get smart on regulation and start competing with those emerging markets, those challenger cities. And we'll see if St. Bart's can climb the charts from number 10 and overtake Dubai one of these years.
Brilliant. Thank you so much.
Thank you.